So the spread has operational costs, it has the shareholders' expected return, and then it has the risk element. Now, those three things are the things that determine how far the interest for lending will go. Smart people ask questions. Smart people seek facts. Smart people solve problems. But the smartest people challenge themselves among their peers. Join the first of its kind, the army of smart people, and lead the world. I am your captain, Duncan Robert Ahuya, your number one public informant. Please subscribe, like, comment, and above all, invite your peers. Welcome again, ladies and gentlemen. My name is Duncan, and as you know, this is a knowledge channel where we just intend to learn more about our countries, we learn about our economies, we learn about businesses, finance, and everything else that we need to learn about this world. We are taking advantage of information because we know that information is available and in plenty. So why then can't we share knowledge? Why can't we have a channel, our own, that we can break down some of these concepts that we always want to know, but we don't really know where we can get simple explanations to these complex issues. So if you're here for the first time, guys, I really pride myself in leading this army, and I would love that you join us. And the best way of showing that you're joining this army is to subscribe. Click that subscription button. We want this channel to grow, because you know when the channel grows, we are getting more people involved and we are sharing more data, more information, and we definitely will become better. So there's a series that we have been doing. We are trying to understand the financial sector in Kenya, and we have started with the banking sector. So today I want us to focus something on a big component of banking sector, and therefore it affects us one way or the other. So there are some frequently asked questions that people will want to know, and I'm very excited and ready to explain to you to the best of my abilities. It's a new channel, but we have started on a high, and we hope that we shall keep up the pace and more will be coming your way. Now, to start us off, before you even understand all the complexities that come with interest rates, why can't we then know what is interest rate? An economy in any market, whatever is being transacted normally, is you come with your product and then you are expecting to get buyers. So you are the seller, then there's a buyer, then there's a commodity. Now, in the financial market, and in this case, in the banking market, it operates the same way. It's just that now the banks don't have commodities. Their commodity is money. So money is what is exchanging hands. Now, buyers in the banking sector, buyers to money are called borrowers. They are called borrowers. So people who come to the bank to borrow, you are the buyer. While people who have money and they deposit their money to the bank, they are the sellers of the money. And then the bank is the person or is the institution that ensures that transactions happen. Now, for someone to give you their money, then they expect you to pay them. And the pay that you give to them is the interest. While at the same time, if you're taking money from the bank, then the bank is expecting that you will pay them interest. And then bank will compensate the buyer, the sellers, and then bank will remain with something small for themselves. And that difference between what you're paying the bank and what the bank is paying the sellers, that difference is what is normally called spread. You now know what it is. It is the difference between what you pay the bank as a borrower and what the bank pays the seller as a deposit. I hope we are on the same page up to that point. Now, let's now try and understand what makes up this spread. The spread has three components. The spread is made up of the shareholders' expected returns. Because you know, a bank is a company, so there are people who have invested in that bank and they're expecting returns. So in that spread, there's a small component of it that is a shareholder's expected return, and that is like the profit. And then there's another component of that spread that is called risk. So any person you know, any person who borrows money, any entity that exists in an economy has a risk factor. And the risk factor when it comes to banks is that the probability that you will not pay back. So banks have to put that into consideration. How risky are you? And we all know that to determine how risky someone is, we rely on credit rating bureaus. Those bureaus that are licensed to have your information and to determine how risky you are as an individual. Of course, based on historically, how many loans you have taken, How loyal have you been to the level that you are able to repay all the loans back? How stable are you in terms of employment and your source of income? All those kind of things, they influence the determination of your risk factor. And actually, even countries have a risk element. There are countries that are risky. There are those countries that are not risky. They're risky, but not that much. And those things contribute to the determination of the risk factor of the spread. And even governments. Actually, governments have a risk factor. And that is why if you go to underdeveloped or developing countries, you'll find that their interest rates are higher. It is because of that factor. And then finally, on the same spread, we have this thing called operational costs. So banks are a business and they incur costs to operate. So those costs are also absorbed into that thing called spread. So the spread has operational costs, it has the shareholders' expected return, and then it has the risk element. Now, those three things are the things that determine how far the interest for lending will go. How risky that economy or that individual or whoever is will determine how far that lending rate will go. And that then tells you now understand how much control banks have on interest rates. Banks have control only to the level that they can determine the shareholders' return and they can determine the operational costs. All other factors, all the other components of the interest that they charge is not so much in their hands. Because even the rate that they give to depositors, the deposit rate, interest rate, is normally given by the Central Bank of Kenya. It is not in the hands of commercial banks. So sometimes, if you definitely now want to differentiate between a cheap bank to an expensive bank, you just need to look at operationally how efficient are they in terms of their costs. And how greedy or how much do their shareholders expect from the bank. That will always tell you where the difference between different banks come from. Now that we understand what interest rates are, let us try to answer some of those frequently asked questions. One of the questions is, why do some countries have lower interest rate than others? In this world that we live in, we have developing and developed countries. Developed countries are stable, and stability is determined, of course, by how well they can be able to sustain a certain performance of the economy. So they can sustain a certain level of output. They can sustain a certain level of employment. They can sustain a certain level of liquidity. Liquidity is how much money is circulating in the economy. Now, developed countries have a lot of that when it comes to stability. And because of that, it means since the market is liquid and there is a lot of money circulating, banks have a lot of money to give. You don't rely so much on deposits. You don't really rely so much on new people depositing money. And because of that, it means that whoever is depositing money with you, you'll have to give them just something small in terms of the interest. And on the other hand, since you have a lot of money to give, you will also want to encourage people to take loans. And because of that, you will want to maintain your interest, the lending rates lower. And that is why when you go to most developed countries, the interest rates are very low. But that is just one of the factors. The other factors is the risk. Like the one I told you, risk is higher in developing countries than in developed countries. And even within developing countries, there are some countries that have a higher risk. Like South Africa will have a lower risk, than Kenya. Why? Because South Africa is developed beyond the level that Kenya is. And that means the operational costs of their banks are usually low. Why? Because they have introduced and they have inculcated something called technology into their systems. They have introduced systems that are functional, and they have replaced over-reliance on human intervention to carry out their banking services. And as such, the operational costs are lower. And then because of that, their risks as an economy as well, the stability of the economy enables them to also have a lower level of risk. So guys, that is what normally influences or determines why you will find that countries have different interest rates. Now, also, there's this something called policies. Different fiscal policies affect the interest rates of a country. Fiscal policy is basically government revenue and government expenditure. Where is government getting its income and how is the government spending? Now, countries that have a good economy, most of the time their governments don't borrow a lot, especially domestically. So it means that the government is able to get enough income from taxes. And as a result, then it means that the government is freeing up a lot of the money in the economy to be available for lending. Now, what will that do? That will, of course, decrease the interest rates. But when the government of the day is borrowing too much money from the economy, that means that the banks will want to, of course, give their money to the government and not to the people. And therefore, there will be less liquidity, and less liquidity has an impact of increasing the interest rates in the economy. That is what determines also what affects the interest rates. What is the impact of high interest rates? Guys, high interest rates are never a fixed condition. High interest rates keep changing, and like I've told you, they are majorly influenced by something called macroeconomic factors. So when you see an economy having high interest rates, it is never a permanent situation. It changes, and it will change because it is affected by inflation, and of course it is affected by the value of the currency of the day. But remember, the value of the currency of the day is determined by something called liquidity. So the next question is, someone asks, if then low interest rates are a good thing to the economy, as we have seen in developed countries, because then people can be able to ask and borrow money, and people can invest, and as such it will spur economic growth. Why then do we have high interest rates? Why do we have banks charging high interest rates? It is in the interest of all the players in the banking sector to have a stable economy, and especially stable interest rates. It is not in the interest of the banking sector to have high interest rates. So it is not good for them, because then high interest rates means people will not borrow. Whatever rate of inflation you see is a sweet spot that is arrived at, so that all the stakeholders of the banking industry are happy. Banks can only manage to reduce what I've told you. They can only manage to reduce their operational costs and their expected returns to the shareholders. But these other things are predominantly influenced by the economy. They are predominantly influenced by your market forces, the forces of demand and supply. And that is why a bank cannot just wake up and decide that I'm going to reduce because if they do that, then they run the risk of not making profits, so they'll not be able to pay their shareholders, or not making anything enough to keep their costs going. Then what is the meaning of operating a bank if you are not making money? So at the end of the day, it is not about having low interest rates. At the end of the day, is arriving at a place where a soft spot where you are able to lend and you're able to compensate your depositors, while at the same time managing the macroeconomy. Yeah, and of course now spurring economic development, growth and development, because the goal in this case is to spur economic growth. And now that job of getting a sweet spot for the interest rates of a country is now usually determined by the Central Bank of Kenya, as in the case of Kenya. That is what the Central Bank does, of course, in coordination with the Treasury and in coordination with the commercial banks. And in Kenya, I think there is Kenya Bankers Association. So all the stakeholders play the role in making sure that they find that sweet spot where the economy can be spurred while taking care of all the interests of the players of the banking sector. I think I've answered a few of your questions, and if you have any more, you can put down those questions on the comment section. And keep it locked. Every single day we'll be continuing with this series on the financial sector, and for now the banking sector. Tell me what you want me to talk to you about, and I'll be glad to answer and to give you feedback. It is my time, and please subscribe, please share, and also like what I am doing, because it encourages me, it keeps me going, and it keeps us going. Thank you very much. See you again on this channel.